Hi, everyone. Jared Levy here, Director of Investment Strategy here at DBHW with your second quarter recap and outlook. Things have changed quite a bit from where we were last quarter. When I joined you here last time, markets were reeling after the Liberation Day tariff announcement by President Trump. The S&P at that point down over 10% in just 2 days. We saw trillions wiped out in equity value alone, and volatility was screaming through the roof. And there was a lot of doubt about the future of economic health here in the U.S. And what I could say right now, obviously, we stand at a much different point. Markets are, in many cases, hitting all-time highs again here in the U.S. Remember, last quarter we saw that 90-day pause to most tariffs. And that happened kind of in early mid-April. And that's what triggered this sort of quick rebound, right? The goal here, guys, or the key to all of this, is the simple fact that two things. We want continued economic growth, and we want to make sure the Fed is going to reduce interest rates, which also means minimal inflation. All right. In terms of equity performance over this past quarter, the Russell 3000 up 11%, the S&P up 10.5%, small caps still lagging, they were up 8%. Global equities have been a real popular place for people to put their money, right? We've seen in developed markets up 12% this quarter, emerging markets also up about 12%. So again, investors looking outside of the US for potential profits. Now, does that mean we're moving all of our money out there? No, but we've maintained a small amount of exposure internationally. Let's talk about earnings this past quarter. Q2 profits, they're growing, or they grew, but they dropped from about 5 to 6% versus expectations of about 10% just at the start of the quarter. So what does that mean? It means that companies are still making money overall. They're growing their earnings overall. They're just growing it slower. Now, the fact that stocks have propelled themselves to 52-week highs means that investors are okay with that slower growth. So that essentially means that expectations remain fairly low. Okay. Now, that's a good thing, right? When you're not pricing in perfection, that's a good thing for stocks. Does it mean we go all in on risk? No. And in fact, in terms of what we're looking for in terms of economic growth, I think the current estimate is somewhere around 2.5% GDP growth this year. We at DBHW think that's going to be a little bit lower, probably closer to around 2%. We still do have concerns about recession. We are still coming out of a negative quarter of GDP growth. But again, we're not going to have this data out for a little while. Q2 is expected to rebound. All right. Inflation, again, still under pretty much good control here, coming in around 2.7%, somewhere in that area. We think that real inflation is actually a little bit lower. Obviously, inflation is going to show up in certain areas versus others. With the tariffs, obviously, that's going to impact, certain sectors more than others. And, for that, we're kind of staying, again, a little bit more defensive. The labor market, well, jobs market seems on the surface pretty strong, but we are seeing cracks. We've seen hiring slow. We saw the first contraction in ADP jobs, which means there was negative jobs growth. And I believe that was in the third week, that was it was delivered in the third week. That was for the June number. So again, you start to see that data. And again, the Bureau of Labor Statistics kind of showed a contrarian view that the labor market has continued to be strong, but we are seeing cracks there. We're seeing increased layoffs. We're seeing a much larger slowdown in hiring. And again, a lot of empty jobs because there's been this labor swap I've talked about. Companies have gotten rid of, middle management, upper management, a lot of higher paying jobs and replaced that with lower paying jobs. The Fed, again, is holding tight here. We're looking for at least 2 more rate cuts this year, or 2 rate cuts this year. There haven't been any. We're thinking that's going to come later in the year. We are worried here that interest rates remain high. Why? Well, the big, beautiful bill was passed. It is now law. Obviously, it has to be interpreted by the Social Security, by the Treasury, and doled out across all the different entities. But that bill is moving forward. Half of that bill, or I should say half of the room, agrees that at least that this bill is going to be stimulative. It's going to drive markets and economic activity. And that's going to help equities and stocks. But on the other side, the fixed income markets, the bond markets, they're concerned that this is going to cost the US money. And it also reduces our credit rating. Why? Because again, we're spending a lot more money. Just think about that basic income equation. If you're a borrower and you're spending a lot more money than you make, your credit rating is going to go down. And thus, you're going to have to pay higher interest rates on your loans. That's what people are worried about here in the US. And that's why we're a little concerned with longer term rates. Now, volatility, it's come back down. We're still not out of the woods, guys. I don't want us to get into the idea or thought that everything's going to be clear sailing from here and market's going to continue to go straight up and we're going to have mid double-digit returns, or I should say mid-teen returns plus in the S&P. No. I think economic growth, moderate. I think stocks will continue to be volatile as we come into the fall here, as people get back to work. Remember, summer, it's typically a quieter period in the markets. Usually they say sell in May and go away. And that's because volumes are lighter. A lot of folks are on vacation. Markets tend to do weird things in the summer. For this summer, it's been a quiet one. I actually think we're going to pick up much more volatility in September, October. And remember, those are the periods, specifically October, is when we tend to see market correction. So we could still see more of that. Labor market will continue to cool, we believe. Unemployment will tick up slightly towards the end of the year. But again, we remain cautiously optimistic. And hopefully for you, if you're an account holder with us or a client here, we are diligent with watching over your account, ensuring that you are all positioned both according to your risk, but obviously, best invested for this marketplace. We do think international will continue to be strong, but select international markets. We are nervous about China. We're not just saying go buy, international blindly. We're being very selective there. We also believe in the future of AI and quantum computing. You might see that if you're a client in some of your portfolios. And, we've owned Bitcoin now for some time. Bitcoin also continues to make fresh highs and has looked very strong and has, believe it or not, remained relatively docile compared to the overall market. Again, my name is Jared Levy. I wish you guys a great rest of summer, and we'll be back here to talk to you soon here at DBHW. Have a great day.